Hi there. In this video, we will go through the exercises of chapter 6. And in this chapter, we will talk about the intercompany transactions, whether they are selling inventory to each other between the parent and the subsidiary, or they have accounts receivable and accounts payable, or there is a loan that has been given from the parent to the subsidiary and vice versa. And with this in mind, I will go through these 4 exercises in this video. I will explain the journal entries and the calculation we need to do to get the results. So in the first exercise, here we see that a parent company purchased 90% from the subsidiary, and this happened back in 2011. In 2014, after 3 years, the parent company purchased some units, 57,000 units, and they sold some of those 50,000 to the subsidiary. So they sold 42,000 and for a higher price. So here you can tell that the parent company purchased for $25, sold it for $31. It means the parent company made a gain of $6. And then the subsidiary sold all the quantity to another customer for $46. And now we need to do the journal entries that has been made by the parent, and then the subsidiary, and then the consolidating entry. So when we talk about here the parent company, we talk about the purchase of the product originally, and the sale of these units, 42,000, to the subsidiary. If the company is using perpetual inventory system, as it shows here, then we use merchandise inventory in all the times. If the company is using periodic system, which we don't have it in this chapter, we use purchases, merchandise inventory, cost of goods sold. But for the sake of convenience, both the parent and the subsidiary, they use the perpetual inventory system, which I put it here. So what shall we do for the parent company? When the company is buying any inventory, whether it's for subsidiary or for itself, the parent company will debit merchandise inventory or inventory, credit cash, or accounts payable. And here we see that the parent company purchased 57,000 times $25. Then how the parent company is going to register the sales of 42,000, we make 2 journal entries, one for the selling price and one for the cost price. And here are the journals. For the selling price, we debit cash or accounts receivable, credit sales. We multiply 42,000 by 31, and then another one for the cost price, debit cost of goods sold, credit inventory, by 40,000 times 25. And here you can tell that 25 is the cost of the parent, which has been reflected. Now the subsidiary will buy the inventory from the parent. So we assume the subsidiary is going to make this journal for the 42,000. So here we debit inventory, credit, cash or accounts payable by 42 times 31. Because this is the cost price for the subsidiary. And then the subsidiary will sell it to the outside client. And here we make 2 journals. We debit cash, credit sales by the selling price 46. And we debit cost of goods sold, credit inventory by the cost price 31. So now we finished everything. And we need to do the consolidating entry between the parent and the subsidiary. So here we need to close off the sales and the cost of goods sold. How we close it off? Here we can see that the company made sales here for 1,302, and the cost of goods sold 1,302. These, what we call it, intercompany accounts need to be closed. So if the sales credit, when I close it, I make it debit. When the cost of goods sold is debit, I make it credit. And this would be the answer for the first exercise. The second one, more or less like the first one, except here the parent company purchased some merchandise, 41, and they sold 26, but by the end of the year, the subsidiary didn't sell all the 26, they sold 19. And the difference, which is 7,000 units, is still in the warehouse of the subsidiary. So in exercise 1, we see the company purchased all the quantity. Here they purchased 42 and they sold 42. In exercise 2, they purchased 26, but they sold 19. And this will make a difference in the journal entries. Now we need to do the 3 journal entries we did it for the parent as we did here. We need to make it in exercise 2. So we debit inventory, credit cash or accounts payable, debit cash and credit sales, and then debit cost of goods sold and credit inventory. So the accounts will be the same. It will not change. Here we purchase 41 as a parent. We debit inventory, credit, cash. Then we made sales at a higher price, $20. So we debit cash, credit, sales. Then we debit cost of goods sold and credit inventory by 60. And I put it in bold here to remind you that this is the account that I need to close at the end of the day. For the subsidiary, we make 3 journals. The accounts will be almost the same. You debit inventory, credit cash, debit cash, credit sales, and cost of goods sold. So we have no issues here about the accounts, but our problem will be with the amounts. Here, the subsidiary purchased 520, which we put it here. But when we sold, we didn't sell the 26,000. We sold 19,000. And here is their selling price, and here is their cost price. And of course, here you can see the cost of goods sold. So how can I make the closing entry? We debit sales because it was credit by 520, which is here. And then credit cost of goods sold and credit inventory. The cost of goods sold is a bit tricky here because we take the 380, which is 19 times 20, plus the cost of the 7,000 for the parent. When the parent purchased the 7,000, the cost was 16. So I multiply 7,000 times 16, and this would give me the total of 492,000. If we add, of course, those 2 amounts. Now the remaining inventory, which is 7,000 units, times the difference between the selling and the cost, $4, will go here under inventory. Why I credit the inventory? Because we didn't sell these goods. Yes, we sold it from the parent to the subsidiary, but it didn't go to the final customer. And this would be the second exercise. The third exercise is a bit longer because in this exercise, we see some transaction or sales coming from the parent to the subsidiary. When we get these sales, we call it downstream. And starting from this example, and in the next example, you will hear the word downstream and upstream. What is the difference between them? If the parent is making sales to the subsidiary, we call it downstream. If the subsidiary making sales to the parent, we call it upstream. So here we see the parent, which purchased 70% from the subsidiary, made sales to the subsidiary here for 118,000. And the subsidiary, this one, we call it downstream. The parent sold to the subsidiary for 180. The subsidiary, which is Sun Company, sold to the parent 316, which is upstream. Now, at the end of the year, we see balance sheet contains 104 inventory purchased from Sun. This means when we buy from Sun, it means Sun made the sales to us. It means this is upstream. And here we see 104,000. The cost of this one was 64,000. So the unrealized gain from this sales upstream 40,000, we will take it and then divide it between the parent, which will take 70%, and the subsidiary, which will take 30%, as you can see it here. The parent took 70 and here 60, or 30. Now, the parent made sales to the subsidiary for 31,000 and the cost was 18,600 here. So the unrealized gain 12,400. If the sales is coming from the parent to the subsidiary, there is no NCI. So I cannot take the 12,400 and divide it between the parent 70% and NCI 30%. Why? Because all the amount is belonging to the parent, not the subsidiary. So now we see the total sales that happened, 118 plus 316, and this happened in 2018. And then later on, we can see here that the sales upstreams and downstreams happened. And at the end of the year, we see the income 75,000 and the dividends 15,000. So what shall we do here? We need to do the closing entry. I don't need to make the unrealized gain or unrealized loss as I did it here, because the question doesn't ask for the journal entries, but the question asks for the consolidating entries. If we go back here, it says prepare all consolidation entries. This is the reason in that example, you will not see the journals. We have it in examples 1 and 2. And here is the balance sheet at the end of the year. Now we see here the retained earnings, 232 at the end of the year, which means the ending balance of the retained earnings, 232. Now I need to get the beginning balance of retained earnings. How can I do that? I need to include the dividends and I need to include the net income. The dividends in this example, 15,000. The net income, 75,000. So how much is the beginning? We get the ending plus the dividends minus the net income, we get 172. And of course, if we go downwards, we get beginning plus net income minus dividends, we will end by the retained earnings. And this one is what I'm going to put it in the consolidation entry 172. So we take the first amount 133 and put it here under common stock. Retained earnings 172, which we did it here in our calculation. Now, how much is the income? As you can see here, the company made 75,000 income. We should get 70% to the subsidiary. If I take $75,000 multiplied by 70%, we get 52,500. Then 70,000 times 30%, we get 22,500. But from those amounts, I need to remove the unrealized gain, which comes from here, the upstream and downstream. For the parent company, there are two portions. The downstream portion, which is 12,400, and the portion of the upstream, 28,000. So I subtracted from here. 31 minus 18,600, which we have it here, 12,400. And then 40,000 times 70%, we get 28,000. When I subtract 52 minus the amount 12,400 minus 28,000, I will end by 12,100. So this is the first one. The NCI, they don't have any portion in the downstream, but they have a portion in the upstream. So I took their portion 22,500, but I only subtracted 30% from the upstream unrealized gain, and we get the NCI here. For the credit side, we credit dividends by 15,000, which is here. We credit investment in the subsidiary, which is also here, 12,215,100. And now we need to get the NCI. How can I get the NCI in the net asset? I start from here and I start going line by line. From the common stock, we need 30%. From the retained earnings, we need 30%, and this is what I put it here. So we get common stock and retained earnings multiplied by 30%. From the net income, I need 30%, which I put it here, 22,500. And then I subtract the dividends, which is 15,000 times 30%, and the unrealized gain, which is 28,000 times, 40,000 times 30%. When you do the calculation, then you end by the journal entry for the consolidation. The last one, prepare a consolidated balance sheet. So we need to do the balance sheet, but I need to do the journal entry for the sales. We did the sales here for the total 118 plus 316. We get 434, which we put it here. Then the unrealized gain, whether downstream or upstream, we add them together. So if you remember, in the downstream, we have 12,400. For the upstream, we have 40,000. So here we add them, we get 52,400. The difference between the sales and the inventory is the cost of goods sold. And here you can stop my video, look at the consolidated balance sheet, and try to do the calculation, and you should get them equal, where total assets is 974,600, and the same thing for total liability and equity. The last point here, exercise 4. Exercise 4, it's a bit longer, because the parent company purchased the subsidiary company a few years ago, back in 2019. Then in 2018, they made intercompany transaction. And in 2019, they made also intercompany transaction. So in 2018, the intercompany transaction should be added. The unrealized gain should be added. And the unrealized gain for 2019 should be subtracted. And this is what I did it here. So we need to do this calculation to get our journal entries correct. What you see here, it's the trial balance for 2019. And as you can see here, on January 1, 2019, which means the transaction or the information, you see it in the second paragraph, it comes from 2018. And the third paragraph, it says during 2019. So here the information goes to the current year of 2019. So we have the purchase on 2015, unrealized gain and from downstream and upstream in 2018, and again unrealized gain downstream and upstream in 2019. So let us take those three chunks and try to split them out. If we break them down, here we see that the fair value of the subsidiary company, it was 301,700 plus the NCI 129 minus the book value 395. We get the difference, which is the extra between the fair value and the book value, 36. If you remember those 36,000, we used to call them goodwill. But here he said 14,000 out of the 36 should go to the land. And the difference will go to the goodwill. And this is what I'm going to put here later on, by the way, in my journal entries. I will say debit land, debit goodwill, credit investment, credit NCI by 70% and 30%. So this would be the first part in the example that happened in 2015. In 2018, he said, Pizza's inventory contained 38 of unrealized gain reported by said. which means if pizza has the inventory, it means this is sales coming from the subsidiary. It means it's an upstream. And then on that date, said inventory contained 15,000 coming from pizza. So this is downstream. I will take the upstream 38,000, divide it between the parent 70% and the NCI 30%, as you can see them here. The downstream cannot be divided. All of it will go to the parent company. In the same way, in 2019, we get upstream 25,000, which is the difference between 66,000 and 41,000. And the downstream will be 41,000. However, the parent company didn't sold some quantity to the subsidiary, and the subsidiary didn't sell all of it. If you can read the last part here, it says, said continues to hold 35,360. So the parent made sales to the subsidiary, and by the end of the year, the subsidiary couldn't sell all the quantity. Some of the quantity remained in the warehouse. So what shall we do? From this quantity, I need to take the net profit, the unrealized gain. So I subtracted 104 minus 62,400 divided by 104 to get the profit percentage. Multiplied by the income 35,360, we get the unrealized gain 14,144. Now we add here the unrealized gain 25 plus 14,144, and this would be our inventory 39,144, which I'm going to put it here. When I close off the sales of this year, I will say debit sales by 170, credit cost of goods sold by 130,856, and inventory 39,144. How do I get the sales of 170? It's this amount. If you add 66 upstream plus 104 downstream, we get 170, which is total sales. Now, we need to start making our journal entry, the consolidation here, debit common stock. But if I run and do this journal entry before the calculation I'm going to show you, most probably the amounts will be wrong. So what shall we do? Before we make this consolidating entry, we need to create the shareholders' equity report, then income statement report, then dividends. Here we start by the shareholders' equity, 165 plus 256. If you add them, you get 421. I took this amount, divided 70% to the subsidiary, 30% to the NCR. I did the same for the income statement. In the income statement, you can see here, we have sales, 214. We have cost of goods sold, 143. And we have depreciation expense, 20,000. When I put those together and subtract sales minus cost of goods sold minus depreciation, we get net income. We take the net income divided 70% to the subsidiary, 30% to the NCR. And finally, we get the dividends from here, 6,000 divided 70% to the parent, 30% to the NCR. Excuse me. Now we need to calculate the investment for the parent company. And please, when I say the investment, don't run and catch this number, 319,757. This number will show me when I finish all the consolidating entries. So the number you see it here, it's after all the transactions, not before. So which one should be my beginning point? my beginning point is this one. Common stock and retained earnings, when I add them and multiply it by 70%, I will get 294,700, which is my beginning balance, 294,700, plus my portion of income, 35,700, minus my portion of dividends, 4,200. I get the ending balance of the investment. But now I have unrealized gain coming from 2018 and unrealized gain coming from 2019. The one that comes from 2018, it was subtracted. Now I need to add it. And the one for 2019, I should subtract it. So let us go here and add the one from 2018. From the upstream, I will take 70%. From the downstream, I will take all of it for the parent. So we have here 26,600. If you remember the 38 here, 38,000, we multiply it by 70%, and then we get 15,000. So here, 15,000 and 26,600, which is 70% from the 38,000. From 2019, as you can see here, we have the upstream, we take 70% from the 25,000 and 14,144 for the downstream of the unrealized gain. And here you can see 25,000 times 70%, we get 17,500. And 14,144 will be the downstream portion. When we add ending plus gross profit from last year minus the unrealized gain of this year, we get 336,156. This will be my investment account here. Now I need to do the same accounts to the NCI. The only difference between these accounts and here, that in the NCI, we don't see downstream. Why? Because the downstream gain or loss, it's only for the parent. So we do the same beginning. Here I got the common stock and retained earnings multiplied by 70%. Under NCI, I will multiply by 30%, and this would be my beginning point. Plus net income here, 15,300, minus dividends, 1,800. And then I get 38,000 multiplied by 30%. And then 25,000 multiplied by 30%. Here we add 139,800 plus 11,400 minus 7,500. We get the NCI. We take it as we did here. We take those two amounts and put them here. So we have investment and then NCI. Now I need to complete the rest of the journal entries. So we put common stock here by the original amount, 165. Then we debit retained earnings, 256. And then we debit income, 45,655. And you might wonder from where I get this number. It's given already here, 45,656. And then we get the investment, the dividends, 6,000, and then the investment and the NCI. How do we get the NCI in the net income? We get 15,300, which is their portion of net income, plus 11,400 minus 7,500. So this is the consolidating entry. Now we already did the review for the extra payment between the fair value and the book value, and we divide the goodwill between the parent and the NCI. We did the same for the sales here. The only one that will be remaining, the unrealized gain or downstream or upstream from 2018. Here we debit investment, debit NCI, and credit cost of goods sold, as you can see them here. And take these ones and let us add them. So what do we mean by add? I will add 336,156, which is the investment here. It's a credit. And then the investment here, 25,200, which is also credit. So you can see here two investments. Here there is no investment. And here we see the debit investment minus 41,600. We get 319,756, which is here. 319,756. So now we need to take these journal entries. By the way, all the calculation here are not required in the exercise. The only requirement is making these journal entries. But you cannot do the journal entries without the calculation. Now, if you go here, I don't think I need to spend much time consolidating the worksheet here between the parent and the subsidiary because you already know it. So here we get the sales. We remove the intercompany sales, which is 170. We get the cost of goods sold and remove the cost of goods sold between the companies and remove the income from the subsidiary completely and create the new one for the NCI. This should give you 136,656, the net income. We know from the prior examples that in the retained earnings, my net retained earnings here should be matching to the parent. And then we do the balance sheet where we have the total assets equal total liability and shareholders. I hope you find this short video useful, explaining how to make the consolidation and the intercompany accounts. If you need anything, please let me know. Thank you. Bye.